What's going on, investors? This is Dustin from Forward Investing, bringing you more investing content. Guys, today we had a huge red day, not just for the S&P, but for the NASDAQ, for the Dow, for all the major indices, all the small cap stocks. Oh boy, did we feel some pain today in the market. Biggest culprit for that being the volatility index. So you can actually notice a trend here today at around 2 o'clock p.m. in Eastern Standard Time. We saw a huge spike in volatility, and then essentially every major stock followed suit with at least a 1%. Well, if you look at it, the vast majority of them are probably, even 2 or 3%. Let's just name off a few names. Amazon down 1.7%, Costco down 2.41%, Apple down 2.58%, Facebook down 3.56%, Google down 4.65%, Microsoft following closely behind, negative 3.62%, Tesla down 5.75%. So what we've actually seen here is a complete reversal from the great news that we got a few days ago. So Tesla published some amazing results. They over-delivered on their vehicles. People were enthused. Stocks went up by 11% in one day, and then now we've just been hit with a -4%, -5%. We're back down to essentially where we were before that amazing news. So that means even with Tesla's over-delivery priced into the market, we're still seeing people say, you know what, the negative economic factors and outlook are so bad that it completely negates the fact that Tesla is actually doing better than expected. Think about that for a second, because that is not a good sign. Really, the cause of this and the reason the volatility is up so high and everything's down so low, because again, high volatility can go one of two ways. It can be high upward trends or high downward trends, so to speak. So the reason we're observing this in the market is because of the good old Federal Reserve. What is the Federal Reserve up to these days? Well, essentially, they're saying in the nicest way possible, just going to adjust my mic here, they're saying in the nicest way possible that essentially they're going to jack the rates up. They're going to increase the rate that they're going to try and, recover from the high inflation rate. And as a result, things are going to be way more turbulent. So the long and short of it, the simplest way to explain it, essentially what the Federal Reserve has done is, if we're on a plane, the Federal Reserve has just gone on the speaker system and said, no need to panic, folks. We're going to be expecting higher than normal turbulence. Please make sure you're buckled in. And what does that mean? It means that there's a higher increased chance that the plane is going to crash, right? There's no other reason to tell people on the plane that there's going to be turbulence other than, facing some sort of adverse situation where there is a inherently higher risk of the plane crashing. So what are we seeing here? We're seeing people feeling fear, uncertainty, doubt, the FUD factor, because it is becoming increasingly less certain which way the economy is going to go here. So this is what you should expect moving forward. I anticipated that things would be green for at least January, February, and that we would see recessionary factors later on in the year. It turns out that because of the statements of the Federal Reserve, that prediction I'm actually pushing a lot sooner. I think that by the end of January, we should have a really good idea of whether there's like a very strong 95% chance of a recession, or if things are going to pick back up. And right now we're just experiencing that turbulence, and we'll be on we'll correct the course and smooth sailing from there. That's my prediction, okay? And I think what's going to happen as a result of that is, if economic prospects are starting to look good at the end of the month, then all of this major red you're seeing is actually a good thing in disguise, because as you know, when you buy the dip, it means that when everything goes back up, you're going to be making a lot of money. And when something like Tesla, Nvidia, Google, Microsoft, Amazon, these are some stocks that are, compared to a lot of their competitors, the highest price stock per share on the market. When they're down by a lot and sort of everything is coming down together, you know that when everything comes back up, it's all going to come back up together. And you may say, well, yeah, but that assumes it's going to come back up. That's a great argument, except for the fact that Amazon is not going anywhere anytime soon. McDonald's is not going anywhere anytime soon. Tesla's not going anywhere anytime soon. As we've seen, they're capturing a huge portion of the automotive market right now. NVIDIA is the leading graphics card designer. And if we're going to jump into this vastly enhanced technological future, the metaverse is going to require us to have lots and lots of graphics card capabilities. NVIDIA's not going anywhere. And I hate to say it, but Microsoft isn't going anywhere, because just imagine it's at least 70%, 80% of users are running some sort of Microsoft application, whether that be the actual Windows or some other like on the PC application created by Microsoft. None of these stocks are going anywhere. So even if we have a major recession or start going into a depression, you know your money's safe with these companies because they are so consolidated in the market that everything else would be going bad before these stocks go bad. So what am I saying here? Again, this isn't necessarily financial advice. I'm not necessarily your financial advisor, but what I am saying is that when everything comes back up, it's going to come back up all in a group. So as Amazon goes up, you're going to see Microsoft, Google, and like all these other big names come up. Again, this is going to come out of a result of people starting to fear economic prospects in the future less. So once we see that the turbulence is gone, there won't be anything to fear. And in fact, I think that leaves 2022 having the potential to be, again, another record year where the indices are super high. If we do go into a recession, then actually what we're going to likely see is some fallout for quite some time to come. You know, after the major recessions, it takes a few years for the market to fully recover from something like that. So you can logically deduce that it's either going to be major record year, or it's going to take some time and we might be bearish for another few years. So with that being said, there's not much else to say right now. There's not much additional news coming from the Federal Reserve or the government. The only thing left to really say is, at least where I am in Ontario, there is still the lingering fear of more of a lockdown. So again, if we go into another lockdown because of Omicron, if Omicron gets out of hand, which it may very well, because hospitals are reporting that they do not have enough equipment and staff once again to properly address the number of patients coming in, that can cause the government more than really anything else to start to trigger the same lockdown procedures. The result of that is going to be very similar to what we saw at the beginning of 2020. I think that, you know, stocks like Shopify, Amazon, Costco, Walmart, those are going to be what we go up, because that's what people need to spend money on in times of a lockdown. So keep an eye out for that. If we go into lockdown again, that's a huge red flag. That is a pretty much instant recipe for a recession. I don't think our economy can handle much more of the lockdown procedures. And not only that, but here's another frightening thing that governments have been talking about. There's chances of us going into a lockdown while simultaneously the Federal Reserve and parts of the government are talking about reducing stimulus. So imagine going into full lockdown without any of the financial assistance from the government. That is a very scary thing, whether you're an investor or not. So all of these factors considered, I think that there is a good cause for concern. And keep your eye out as to how the situation unfolds, because either we're not going into lockdown and the market steadies out and everything looks good and we don't have to worry about a recession, or I honestly think that another lockdown could be the straw that breaks the camel's back here. So these things that you can't predict, like no economic trend or technical indicator that I look at can tell me with any degree of certainty whether we're going to be facing a recession at this time or lockdowns. That's completely up to the Federal Reserve and the government. What I can tell you though is if you keep your eye out, as soon as that turbulence subsides, you can be confident investing your money. And for that time being, I would be very, very conservative on what you do invest your money in, because in this kind of market, anything goes. All's fair in love and war. So keep that at the front of your investment brain for the time being. With that being said, guys, that's really all I have to say about today. This has kind of been the theme of what I've been telling you for the past few days, but just be vigilant. Make sure you're keeping your eye on your investments if you're averse to, you know, losing a few hundred or a few $1,000s, because that could happen like this, because that's what we saw today, okay? I don't have anything else left to say, folks. If you're watching, I would love if you could like, comment, subscribe to the channel, follow us on all of our avenues that you could possibly follow us. I'm working on the website, I'm working on the Facebook, so there's lots of great stuff to come. And for the time being, guys, this is Dustin from Forward Investing, wishing you guys the best on your tendies and your portfolio. Bye for now.